Well, I wanted to show everybody a little bit of homework in Cengage, and this is how we'll kind of work through practice problems every week. So I just have the class open in Cengage under our instructor views, the student views. This is what you will see when you log in. And I just have the Chapter 2 assignments out there for you to take a look at. And the ones for points are your Chapter 2 exercises. That's the 100-point assignment. The CPA review and the quiz. Those are the ones that you'll do for points. But there's two assignments here that are more just practice. So this first one here, the deduction for qualified business income for pass-through entities, is purely just for you to do as much as you want. It's a study tool. And so you can do with that as whatever you want. I'm not grading it. I'm not going to look to see if it's done or anything like that. Totally up to you. And then same thing where it says Chapter 2 practice. Okay, these are just what we're going to work through together in this recording. And you can work through these on your own if you want to. You can just watch the recording to figure out how to do these problems. It's kind of just your call. But we'll just get into that. So I already started it once, so I'm just getting back into it. So there's just several problems here for you to work, and I made this be unlimited attempts, and you can get to the answers, and the whole works here. But so as you go through the chapter, and the big topic in the chapter is called QBI, Qualified Business Income. So that's what a lot of these questions are about, is QBI. So the question here, Ellie and Linda, equal owners of Otter Enterprises, a calendar year business. During the year, they had $320,000 of gross income, $210,000 of operating expenses. In addition, they have long-term capital gain of $15,000, and they make distributions to the owners, Ellie and Linda, of $25,000 each. What is the impact of this information on taxable income of Otter, Ellie, and Linda? And then we just kind of go from there. So you can see here with the first question, letter A, if they're a partnership, it will report net ordinary business income or loss of X on their Form 1065. And if it's a partnership, it's pretty simple math. It's just 320 worth of income minus 210 of expense. That's 110. Okay, so just go ahead and type that in. Then they will each receive, basically, what do they get as a partnership? Well, you get a K1. When you read through the chapter, look at the PowerPoint, listen to the lecture, you'll see that. And each will report a net profit of half of that, $55,000. And basically, and then they also will have a separately stated long-term capital gain of, and you can see here it's $15,000 is the gain. They split that evenly, so each receives $7,500, which then is reported on their tax return. Then it says here the 2050 zero preferential tax rate applies to, and then only the long-term capital gain. Okay, long-term capital gains and dividends are taxed at a lower rate. I know a lot of you would have just finished up individual tax, and you would obviously just carry that information over to this class. The partner distributions are basically the questions that drop down. The answer would be do not affect Otter's taxable income and are not reported as income by the owners, Ellie and Linda. The partner's basis in the partnership, though, would be decreased after the distribution. So we have a partnership chapter that we're going to get to where we'll talk about how distributions can decrease the basis in the business. So that was letter A. Letter B, what happens if they're an S Corp? Well, if they're an S Corp, it's going to be a little bit different. If they are an S Corp, the income and loss is the same. It's just that we file it on the Form 1120S versus the 1065, which is the partnership return. So same revenue minus growth expenses, so we still have 110. They will each receive a Schedule K1 still, so that doesn't change. Then it says here, each will report net profit of, same number, 55,000, separately. And so you can kind of see here that we're going to have a long-term capital gain, then also 7,500. So none of that has changed so far. And then, of course, they do get the preferential treatment on the long-term capital gain. Then it says here that the corporation's distributions do not affect taxable income and are not reported. So nothing's changed there, and the basis is decreased. So pretty much everything was the same. Letter C, if they were a C corp, how will it be different if they're a C corp? Well, you can see now it's going to be slightly different. So A and B ended up being exactly the same. For a C corp, though, let's go back up here and kind of look again at the income situation. My revenue of 320, my expense of 210, and the long-term capital gain of 15. Okay, so I use those three numbers to compute my income. So my income now is 125 because the long-term capital gain is basically income to the C corp. Okay, so then we file the form 1120. They will each then receive no schedule from this, nothing at all, because remember that the as a sole proprietorship or as an S corp, those are flow through or pass through entities. So they're going to receive something to show what their income was. For the C corp, it's separately taxable, so it's a different story. Okay, and then each will report net profit of 0 on the stated capital gain because it's already included in the income. So it's not a separately taxable deal at a different rate. No dividends were paid, so don't worry about that. And then let's see. Well, I'm sorry, I got that backwards. 25,000 worth of dividends are paid. They each received 25,000. Now it's dividends. Okay, so that distribution as a C corp now becomes a dividend. The distributions do not affect taxable income and are reported as income by Ellie and Linda. So now they receive a dividend. Okay, so that's the difference between the three. Okay, let's take a look at the next one. That's problem 22. For problem 22, let me get to my notes here. It says that Shelley has 200,000 of QBI from a local jewelry store. The proprietorship paid 30,000 in W-2 wages, has 20,000 in qualified property. Her spouse earned 74,000 in wage as an employee. They earned 20,000 worth of net income during the year, and they'll be filing jointly and using the standard deduction. What is their QBI for the year? Okay, the QBI for the year for them. So this is where kind of some of the rules come into play that we have to keep track of. And the good news here is that they didn't get hit by any limitations in this particular situation. So it's a really straightforward one. Kind of think of it from this perspective of what their income was. So they tell us the QBI was 200. They were paid 30,000 in wages. We have the we also have the 74,000 of wages by the spouse and 20,000 interest income. So those are kind of the things to think about here as we compute that. So we go 200 plus 30 plus 20 is 250, and then I forgot about the qualified property. So the 200 plus the 30 plus the 20 plus this 20 over here is 270. Okay, so that's an important number to know. That's their modified taxable income. Okay, so this is the 270. And so what they do is the lower of, and I'm going to do this in Excel, so I've got an Excel file open. So basically two options here, 1 and 2. And number 1 is 20% of qualified business income, or 20% of modified taxable income. Okay, that's kind of the two options. Well, their qualified business income is 200,000. They just told us that in the problem. They just said it's 200,000. And then their modified taxable income is the 200,000 plus the 30 and the 220s. Okay, that's my 270. 0.2 is the rate for both. I multiply each out, and I do the lower. So the lower number wins. Okay, so I'll just format that so you can see that better. So the lower number wins, and that's 40,000. So the answer to the problem, to go back here, is 40,000. Okay, next problem is problem 23. Peter Samuels owns and manages a single member LLC, does financial services for clients, married, files a joint return with his spouse Amy. The LLC reports $300,000 of net income. W-2 wages are $120. Assets have a basis of $75. Taxable income before the QBI is $285. This is also their modified taxable income. So these gave us the modified taxable income in this example. So that was good. So then we go ahead and we kind of do the same thing. We kind of have to look at the two rules like we had before. And let's see, I'm just getting to my notes here. So we've got the 300,000 here, and we got the 285 here. Those are kind of the two numbers to think through. So let's go back to my Excel, and I've got my qualified business income is 300, and my modified is 285. Okay, and we pick the lower number. This time the lower number is 57,000, and that's what I put in here is 57,000. The next problem, 25. Donald owns a wide variety of commercial rental properties. Single member LLC reports net rental income of $1,005,000. They pay no W-2 wage. It pays a management fee instead to an S corp that Donald controls. The management company pays W-2 wages, but reports no income or loss. His unadjusted basis in the property is $10 million. His taxable income before QBI is $2 million. So what is his QBI deduction then for 2018? Just 1 second here. My notes are just 1 second. I'll be right back. Sorry about the confusion on my part there. I just totally lost track of my notes. Let's go ahead and figure this out for Donald. Okay, so we're going to kind of use the same format here. There's clearly more going on though, so we'll just kind of just take this piece here, and let me just copy and paste this and just move it down a section here. So we'll start down here for Mr. Donald. So 20% of his qualified business income, this time it's $1,005,000. Okay, so that turns out to be a pretty good sized number of 300,000. Okay, then we have to take a look at some of the rules now. Because of the large amount of income, we have to take into account a few of the rules. So, but no more than the greater of. Okay, item 1 is 50% of W-2 wages. 25% of W-2 wages plus 2.5% of the unadjusted balance of qualified property, and that's the apartment building. Okay, so he's got that thing to worry about first of all. So he has no wages, right? There's no W-2 wages, so I'm just going to type in 0 and a 0. But then he has that building. Remember, the building cost 10, or his basis, I should say, is 10 million. So we can take 10 million. Let me make sure I have enough zeros there. I don't know if I do. Nope. Type in one more 0. And I can take 2.5% of that. So take that times 0.025, and I get 250,000. Okay, so that's an option. And then I have one more, And the number 3 is no, let me just do this right here. No more than, and this is 20% of modified taxable income. Okay, so modified taxable income. And that was 2 million. Okay, so that was 2 million. Put in the 2 million right here. And that was at 20%. So we just copy this formula down here, and we get that. Okay, so that's 400,000. Okay, so the answer then becomes 250. So the lower of these two, so clearly 250 lower than 300, but it can't be more than 400,000 under these rules. So 250 is the winner. Okay, problem 27. You can see here, Stella is a CPA, operates her own accounting firm called Water CPA, LLC, single member LLC. She reports accounting firm operations as a sole proprietor. She has QBI from the accounting firm of 540. She has W-2 wages of 156. Her basis in the property is 425. Married, filing a joint return. Taxable income before the QBI is 475. Modified taxable income is 448. So the question is, what is her QBI? Okay, so you can see what the options are. The nice thing is there's drop downs with these two, which kind of gives you a little bit of a heads up with, as you work them. Okay, for Stella, I've already just typed in the number 0 for us there. And you might remember as you went through the chapter, read through it, saw the PowerPoint, listened to the lecture that I did, hopefully you noticed that accounting is one of those excluded specified services. So there's two things going against Stella here when it comes to getting a QBI deduction. Number one is she's a special service. Accounting firm is special service, therefore she doesn't get it, and her income is too high. So even if she wasn't a special service, her income is above the threshold. The threshold is 415,000, so she's above that. So kind of a double whammy. So the answer for Stella is 0. Okay, then we get to problem 28. It says Ben and Molly married and filed jointly. Ben earns 300,000 from his single member LLC, which is a law firm. He reports business as a sole proprietorship. Wages paid were 40,000. No significant property. Molly is employed as a tax manager by a CPA firm. Modified taxable income is 375. Also, their taxable income before deduction for qualified business income. What is their tentative QBI based on the W-2 wage capital investment limit, and determine their allowable QBI? So for problem 28, there's quite a bit going on here in terms of what higher income means that we have to apply some reductions. So I've got an Excel file that will do that for us over here. So you can go ahead and see what we did here. So this is, there's quite a bit going on with this particular one. So it starts right here, is we have to reduce their income. And so we take 375 minus 315, that gets 60,000, divided by 100,000, that gets 40%. And then we have to take that 40% and compare that. We'll come back to use that. But then we go what their QBI is, 300,000 times the 20% is 60, and the percent allowed is only 40% of that. Okay, so essentially that formula is 40%. That's 40% here. Is this 40% here? Kind of the same thing. So it's 24,000. And then we have to look at the W-2 wages. So I've got a couple options here. The 50% is 40,000 worth of W-2 wages, and we multiply that by 50% and the 40% reduction. So you can see that there, I get 8,000. Or I take that and compare it to 25%, 40,000 times 25% times 40% plus unadjusted balance of qualified property, but that's 0. That turns out to be 4,000. And then it can't be more than 20% of the modified income. but we can just go ahead and just go with the 8,000 as that number right there. So 8,000 would then be the answer to this one right here. Then the allowable QBI deduction, we come back to here and we compute that down here. So the 20% QBI deduction, that's the percent allowed, the 24,000 here, less the W-2 limit right here. Okay, in the excess above and beyond that 16,000. Okay, then I reduce that again. I apply the same ratio, 375 minus 315 divided by 100,000, I get 60%. And then I take my excess of 16 right here, and I reduce that by 60%. Okay, so I'm just going to multiply those two numbers out. So my excess, the reduction ratio, I get 9,600. My final QBI, remember, was 24 up here. I subtract from that my excess right here, subtract that, and I get what's left over, which is 14,400. Okay, so that's the number that I will then plug into right here. Okay, then one left. It says here for Tammy, she's a single taxpayer. Part-time job at Big Co. company, no ownership interest. In addition, she owns and operates Little Company, a sole proprietorship that's qualified trader business. She's paid a wage of $40,000 by Big Co. Has $100,000 in qualified income from Little Co. and no other income or loss, and $25,000 worth of itemized deductions. So what is her QBI then, is the question. This one's a little bit easier, much more straightforward. We don't have income limits. She's working for a qualified business, so this one's actually much more straightforward than the last couple of ones that we did. So over in Excel, I've got a little thing built for it. So we go with the qualified business income, and the business, her Little Co. business made $100,000 times 20% is $20,000. Then her modified taxable income is made up of three things: her income from Little Co. of $100, her W-2 wage from Big Company of $40. We subtract her deductions. I mentioned, I think they were itemized deductions. Yeah, 25,000 itemized deductions. And so her modified taxable income is 115. That turns out to be 23. We take the lower number of the two. We all know what that is. We just type in 20,000 and we're good. Okay, so hopefully I gave you some insight about how to work these problems. If you still have questions, by all means let me know, and also work on the study guide too. And just remember, you can come back and work on this and you can get the answers and the whole works too. So if that helps you with the actual problems that are graded, that's the whole goal.